Welcome to the deep dive.
Great to be here.
Today, we're tackling something pretty crucial for anyone involved in Luxembourg finance: hybrid financing instruments.
That's right.
We're talking PECs, CPECs, PPLs, the whole alphabet soup, really. And we're looking at it as of today, May 9th, 2025.
Yep. The landscape keeps shifting, so it's important to stay current. We've done the digging through recent updates, rulings, expert takes.
So you don't have to. This is aimed squarely at you if you're a lawyer, finance pro, director, compliance officer, CoSec, anyone touching Luxembourg structures.
Exactly. These tools, these instruments, they're powerful. But let's be honest, they're under a much bigger microscope now.
Right. So our mission for this deep dive, let's unpack the complexities.
I want to get clear on the key features, the crucial tax implications, and just the general regulatory vibe around these hybrids in Luxembourg right now.
Okay, let's get straight to it then. Preferred equity certificates. PECs, what's the baseline we need to understand?
Well, at their heart, PECs give you a fixed return. Think of something like UK loan notes used in PE deals. It's kind of comparable.
Fixed return, okay. And for the Luxembourg company paying out?
The key thing, traditionally in Luxembourg, is that payment is treated as interest. And interest, well, that's usually tax deductible for the issuer.
Right, so it lowers their taxable profit. Simple enough on that side. But what about the person or entity receiving that payment, the investor?
That's where the hybrid part often comes in. Depending on where the investor is based, their local tax rules might see that same payment differently.
How so?
They might classify it as, say, as an equity distribution, like a dividend.
And that could be good for them.
Potentially, yes. It could mean maybe tax-exempt dividends or favorable capital gains treatment back home. And another big plus for cross-border structures.
Yes.
Luxembourg generally doesn't levy withholding tax on these interest-like payments when they go out to non-resident investors.
Okay, so deductibility for the issuer, potentially favorable treatment for the investor, no withholding tax. Sounds pretty good. Too good to be true nowadays.
Well, too good might be strong, but it's definitely not that simple anymore. You hit the nail on the head earlier, the microscope.
Scrutiny.
Massive scrutiny, especially around economic substance, driven by things like ATAD, the EU directives, and just this fundamental principle of substance over form.
Meaning
Meaning the tax authorities are looking past the legal labels. They want to know the why. Is there a genuine commercial reason for issuing this PEC? Or is it just, clever tax planning?
So the days of just ticking boxes are over.
Long gone. You need a real business rationale. They're looking at the why, not just the what.
Okay, that's clear. Substance is king. Now let's move to convertible preferred equity certificates, CPECs. Sounds like more moving parts.
You definitely have more features, yeah. CPECs really blend debt and equity characteristics. Okay. Typically, they have a really long maturity, think maybe 49 years, sometimes even longer. They pay a fixed interest rate, usually annually.
And that interest rate?
Absolutely critical.
Yeah.
It must be arm's length. What unrelated parties would agree to, that's non-negotiable now.
Got it. Arm's length interest. What makes them convertible?
The clue's in the name. The holder has the right, usually under certain conditions, to convert the CTEC into actual shares of the issuing company.
So they get the regular interest payments like debt, but also the potential upside of becoming a shareholder later on.
Precisely. Equity upside.
What if they don't convert? Or if the company wants them back?
CPECs often have redemption features.
Yeah.
The company might be able to buy them back, usually at fair market value.
Yeah.
And importantly,
Yes.
redeeming a CPEC at fair market value in Luxembourg generally doesn't attract withholding tax, unlike, say, paying a straightforward dividend.
Interesting distinction. Any other features?
Yeah, a few more points. Transferring CPECs is often restricted, maybe linked to owning the underlying shares. In a liquidation, CPEC holders usually rank below senior debt holders, but above equity. And, crucially, before conversion, they typically don't get voting rights.
So, again, this dual nature looks like debt in Luxembourg for deductibility.
Hopefully, yes.
But potentially treated as equity somewhere else by the investor.
That's often the aim.
But ATAD is watching this very closely.
Very closely. That difference in qualification, that hybrid mismatch, is exactly what the ATAD rules are designed to catch.
And the consequence.
If that mismatch leads to a tax advantage, the rules want to stop, like a deduction in Luxembourg, without the income being taxed anywhere else, or a double deduction, then you've got a problem.
Which usually means?
Usually means the deduction gets denied in Luxembourg. Or in some cases, the income might need to be included somewhere else. It forces you to really analyze the tax treatment in both jurisdictions.
Right. Think of, say, Luxco paying interest to an affiliate in a jurisdiction where it's just not taxed. ATAD aims to stop Luxco getting a deduction for that.
Exactly. That's the kind of scenario it targets.
Okay, so PECs with fixed returns, CPECs with that conversion option. Now, profit participation loans, PPLs. The name suggests the return is linked to performance.
You got it. With PPLs, the lender's return isn't fixed. It's linked somehow to the borrower's financial results. Profits, revenues, something like that.
How are they structured?
They can be straightforward loan agreements or structured as debt securities. Sometimes they even include an option to convert into equity, a bit like CPECs.
So they sit in a bit of a gray area.
Definitely. They feel more quasi-equity. Riskier than plain vanilla senior debt, but generally less risky than holding ordinary shares. Companies often use them to get funding without relying solely on banks.
And the tax treatment of that variable profit-linked return in Luxembourg.
If the PPL agreement is properly drafted, and crucially, if that variable interest is considered arm's length.
There's that term again.
Always. If it's arm's length, then yes, it can be tax deductible for the borrower in Luxembourg. And again, generally no withholding tax on the payment going out.
But the big question, I guess, is whether Luxembourg accepts it as debt given the profit link.
That's the perennial issue. Is it really debt, or is it starting to look too much like equity?
Because linking return to profit feels inherently equity-like, doesn't it? What factors sway the decision?
It comes back to that core principle, substance over form. The authorities and the courts look at the whole picture.
Such as?
The maturity date, is it extremely long or even perpetual? That leans towards equity. The company's overall debt-to-equity ratio is completely skewed. How significant is the profit participation? Does the lender get any other rights that look like shareholder rights voting, for instance?
Well,
subordination. Is the PPL ranked below other creditors? And even the actual repayment history. Is the loan actually being serviced like debt?
so if a PPL ticks too many equity boxes,
It risks being reclassified by the tax authorities. And that means losing the interest deduction, potential withholding tax issues. It can unravel the intended benefits.
this substance over form concept really is the foundation now, isn't it? It's not just about the legal form on the paper.
Absolutely. It's about the economic reality. What's actually happening? How is the money being used? What rights do the parties truly have? Are there guarantees? What's the overall financial health, the DE ratio? How do the parties behave?
It's about the reality of the business, real people, real decisions made here in Luxembourg.
That's a huge part of it, yes. The operational substance.
And didn't we just have a court case hammering this home?
We did indeed. Very recently, April 17th, 2025. The High Administrative Court, case 50602C.
What was the gist?
The court denied the existence of a permanent establishment, a PE, mainly due to a lack of substance. But crucially, for our chat today,
Go on.
they also looked at some interest-free loans from shareholders and reclassified them as hidden capital contributions, essentially saying they weren't genuine loans.
Even though it wasn't directly about PECs or CPECs.
Exactly. The underlying message is crystal clear. Substance, genuine economic activity, operational independence, these are vital. Artificial structures set up mainly for tax reasons will be challenged. Anti-abuse provisions are being applied robustly.
So for any hybrid financing, you need that solid commercial rationale backed by meticulous documentation. It has to look and act like what it claims to be.
Precisely. It's not enough for it to be debt on paper. It needs to function like debt, driven by real business needs, not primarily tax avoidance.
Okay, so to help everyone visualize the differences, we put together a quick comparison. It lays out PECs, CPECs, and PPLs side by side.
Yeah, looking at things like instrument type, typical Lux tax treatment, typical foreign tax treatment, return type, convertibility, maturity, withholding tax, just the key differentiators at a glance.
Super helpful. Right, let's switch gears slightly. Which Luxembourg vehicles typically use these instruments? First up, the SOPARFI. Sounds fancy.
It does. But SOPARFIs Société de Participation Financières isn't actually a distinct legal form. It's a tax regime.
A tax regime. Explain.
It applies to ordinary Luxembourg commercial companies like an SA, the public limited company, an SARL, private limited company, or an SCA, partnership limited by shares, whose main activity is holding participation interests and related financing.
So a regular company doing holding and financing can qualify for this SOPARFI tax status?
Essentially, yes. They still have to meet the normal company law requirements like minimum share capital for their legal form.
Okay, so it's a tax label. What makes it attractive? Why use it?
Several big advantages. SOPARFIs benefit from Luxembourg's huge network of double tax treaties. They can often use EU directives, like the parent subsidiary directive, to receive or pay dividends potentially without withholding tax. And they can access Luxembourg's participation exemption, which means qualifying dividends and capital gains they receive from their investments can be exempt from Luxembourg corporate income tax. And SOPARFIs are significant contributors to Luxembourg's tax take, by the way. They're a major part of the financial landscape.
Okay, strong tax advantages. And how do they specifically interact with the PECs and CPECs we've been discussing?
Very frequently, the SOPARFI is the entity that issues the PECs or CPECs, especially in private equity fund structures or structured finance deals.
And the main reason is?
Deductibility. If the PEC is treated as debt for Luxembourg tax, and the interest is arm's length, the SOPARFI can deduct those interest payments from its taxable income. This makes it a potentially tax-efficient way to get funds up to investors, often without Luxembourg withholding tax on the way out. But
always a but, given ATAD and substance.
Absolutely. SOPARFIs issuing these are right in the crosshairs of the ATAD anti-hybrid rules. Transfer pricing is critical. That interest rate must be defensible as arm's length.
What about things like debt-to-equity ratios? I remember hearing about 85.15.
Yes, the old 85.15 debt-to-equity guideline for holding companies. Forget that as a safe harbor. It was never codified law for this purpose, and now substance is what matters. If a SOPARFI is heavily loaded with debt, including hybrids, without a clear commercial need and sufficient substance backing its activities, the interest deduction can absolutely be challenged. Paperwork alone won't save you.
Right, substance again. Okay, SOPARFI is a common issuer. What about investment funds? How do they play in this hybrid space?
Luxembourg's fund industry is massive, and different fund types interact differently. They can be issuers, but maybe more often they're investors in these instruments. Let's touch on the RAIF first, the Reserved Alternative Investment Fund.
The RAIF, known for being flexible, quick to market.
That's the one, launched in 2016. The key thing is RAIFs aren't directly supervised by the CSSF, the financial regulator.
No direct supervision. How are they regulated then?
Indirectly. They must appoint an authorized alternative investment fund manager, an AIFM, and it's the AIFM that's regulated. Our AIFs are for well-informed investors.
And legal forms.
Very flexible. Can be corporate, like a SICAF or SICAF, contractual, like an FCP mutual fund, or partnerships like the SES or SCSP, Special Limited Partnership.
Tax treatment.
Generally very light, usually just a small annual subscription tax, maybe 0.01%. They're typically exempt from corporate income tax, municipal business tax, and net wealth tax, unless they opt into the SICAR regime for venture capital, but that's less common.
So could a RAIF set up as a company issue a PEC or CPEC?
Technically, yes. A corporate RIF could issue them, and the interest would likely be treated as a fund expense. But honestly, it's far more common to see RIFs, especially partnership RIFs like SCSPs, investing in hybrids issued by portfolio companies or holding companies like SOPARFIs lower down in the structure.
Why is that more common?
It often comes down to where the tax deduction for the interest is most valuable in the overall structure and aligning with the fund's strategy and regulatory profile. Issuing complex instruments from the fund itself might attract more AIFM scrutiny.
Okay, RIFs indirectly regulated via the AIFM. What about SIFs, specialized investment funds?
SIFs are different. They're directly regulated and supervised by the CSSF, also aimed at well-informed investors.
Key features.
They have a mandatory risk diversification rule, generally can't put more than 30% of assets into securities from the same issuer. Like RIFs, they can use various legal forms, FCP, SECUF, and usually benefit from that low subscription tax and exemption from direct corporate taxes.
Could a corporate SEF issue hybrids?
Again, possible in theory, but because they're directly under the CSSSI, any complex financial engineering like issuing PECs or CPECs would likely get closer regulatory attention. The fund would need a very clear justification for why it's appropriate and benefits investors.
Is that common?
Less common than investing. In fact, we've actually seen a bit of a trend of SEFs converting into RFs.
Why the switch?
Often driven by a desire for the perceived later regulatory touch of the RAF regime being regulated via the AIFM rather than directly at the fund level by the CSSF.
Interesting. Okay, one more key vehicle. The SCSP, the Special Limited Partnership, hugely popular in PE and alternative funds. How do hybrids fit here?
The SCSP is fascinating. It's generally tax transparent for Luxembourg corporate and wealth tax purposes. Big caveat. Unless it triggers the reverse hybrid rules or is deemed to be running a commercial business itself.
Tax transparent, no separate legal personality.
Exactly. That gives huge contractual freedom in the limited partnership agreement, the LPA. No minimum capital required either.
So would an SCSP issue PECs itself?
Very unlikely. Because it's tax transparent, there's generally no Luxembourg entity-level tax base for it to benefit from an interest deduction.
So its role is?
Typically, the SCSP is the investor. It receives the funds from the ultimate LPs and then invests down the chain, often into a SOPARFI or directly into portfolio companies. It might receive proceeds from hybrids issued by those underlying entities.
So a common structure might be investors, SCSP, transparent, SOPARFI, taxable issuer of PECs, underlying investments.
That's been a very common pattern, yes. The SCSP provides the fund structure flexibility. The SOPARFI allows for tax-efficient financing using hybrids.
But here comes the catch again, reverse hybrid rules.
Exactly. That structure is precisely what the reverse hybrid mismatch rules, Article 168 Quater LIR, are looking at.
Remind us how they work.
If the SCSP, which Lux sees as transparent, has non-resident investors who are based in countries that see the SCSP as opaque taxable.
So a mismatch in perception.
Yes. And if those mismatched investors hold 50% or more of the voting rights, capital, or profits, then the income attributable to them, which might otherwise go untaxed, can become subject to Luxembourg corporate income tax at the level of the SCSP itself.
Wow, that turns the transparency completely on its head for that portion of income.
It does. It's a major compliance headache for fund managers. They need serious due diligence on their investors' tax status and how their jurisdictions view Luxembourg partnerships. Specific guidance was issued on this back in June 2023.
It really highlights how you can't just look at the instrument in isolation. The vehicle using it and the investors in that vehicle are all part of the puzzle.
Absolutely essential to see the whole picture. We've actually put together another table summarizing these vehicles, SOPARFI, AA, SIF, SCSP, showing their typical role, issuer investor, regulator, tax status, and key points regarding hybrids.
That's brilliant. Okay, we've touched on ATAD and reverse hybrids already, but let's delve a bit deeper into this regulatory and tax maze. ATAD first.
Right, the EU anti-tax avoidance directives. ATAD 1 kicked things off in 2019, focusing on hybrid mismatches within the EU.
And ATAD 2?
ATAD 2 broadened the scope significantly from 2020, extending the rules to mismatches involving third countries, like the U.S., and covering more types of mismatches involving permanent establishments, imported mismatches, dual resident entities.
The goal being?
To neutralize the tax advantage, either by denying the deduction for a payment or by requiring the corresponding income to be included in the tax base somewhere. Basically, stop double non-taxation or deduction without inclusion outcomes.
And PECs designed as debt in Lux, equity elsewhere are prime targets, especially cross-border.
Absolutely, especially involving associated enterprises. And remember, for hybrid financial instruments, that associated link can be triggered by just a 25% commonality in voting rights, capital, or profits.
So if you have that Lux debt foreign equity structure between associated companies,
ATAD 2 is likely to bite. The most common outcome in Luxembourg is the denial of the interest deduction. It forces this linkage analysis. You have to know how the payment is treated in the recipient's country.
requires deep tax knowledge in multiple jurisdictions.
Rock-solid documentation to prove your analysis and the arm's-length nature of it all. It's about closing those gaps where income might disappear from taxation altogether.
Okay, ATAD is huge. And the reverse hybrid rules we mentioned, Article 168 Quarter. Let's recap the essentials.
Sure. Effective from the 2022 tax year. Targets Luxembourg entities that are normally tax transparent, like SESPs.
The trigger again.
If 50% or more of the associated non-resident investors view the Lux entity as opaque, taxable, and this mismatch leads to income not being taxed, then the Lux entity itself becomes liable for CIT on that portion of income.
Any nuances from the official guidance?
Yes, the circular from June 2023 clarified things. For instance, if the income isn't taxed at the investor level, simply because the investor has a subjective tax exemption, like a pension fund, that doesn't trigger the reverse hybrid rule. It has to be due to the hybrid nature of the entity itself.
Do these reverse hybrid entities face other issues?
Yes, they have to file a specific tax form, Form 205, and their tax status is limited. They generally can't benefit from the participation exemption or fully apply CFC rules or interest limitation rules in the same way a normal corporate taxpayer would.
Big burden on fund managers then.
Huge due diligence task. Understanding investor tax treatment is now critical. It might even influence which types of investors a fund can accept.
So putting it all together, the tax treatment of these hybrids in Luxembourg is now incredibly layered.
Totally. From the issuer's side, you want that interest deduction. But is it really debt? Is it arm's length? Do ATAD anti-hybrid rules deny it? Are you hitting interest limitation rule caps like 30% of EBITDA?
And from the investor side?
Generally, no Lux withholding tax on interest from PECs, CPECs, PPLs to non-residents. Redemption of CPECs at fair market value also typically okay. But standard dividends from a SOPARFI face 15% WHT unless an exemption applies. And how their home country taxes the income is obviously key.
What about the tax status of the issuing vehicles themselves?
Makes a difference. SOPARFIs are fully taxable, around 24% CIT in Lux City for 2025, plus net wealth tax. So interest deductions directly reduce their tax bill.
But funds?
RIAs and SIFs are usually exempt from CIT and WT, just paying the subscription tax. So an interest deduction doesn't give them a CIT benefit, it's just a fund expense.
And a CSPs?
Tax transparent, so no entity-level CIT benefit from deductions if they issued, which they usually don't. The big worry for them is being caught by the reverse hybrid rules.
Even VAT plays a role.
Can do. Granting credit is usually VAT exempt. The interest itself is generally outside scope or exempt. Issuing trading securities is typically exempt. Management services to regulated funds like SEF can be VAT exempt. But advisory fees paid for setting up these structures are usually subject to VAT, and whether the entity can recover the VAT depends on its own activities.
Phew, it's a complex web. Let's shift to the latest pulse. What major regulatory updates and market news have we seen, say, over the last year or so up to today, May 9th, 2025?
It's been nonstop, frankly. Huge changes. We saw Pillar 2, the global minimum tax, become law in Luxembourg, effective from 2024.
The 15% minimum effective tax rate.
That's the one. Then there's Vita VAT and the Digital Age, adopted at EU level recently, phased implementation starting, big focus on e-invoicing and the platform economy.
What else?
DUARA, the Digital Operational Resilience Act for the financial sector, applicable since January this year. Major impact on ICT risk management.
Any domestic Luxembourg changes?
Yes, a significant tax relief package, Bill 8414, passed late last year, cut the CIT rate slightly for 2025, tweaked some rules for investment funds, revamped the impact regime for attracting talent. Also, modernizing tax administration, mandatory e-filing for some things.
More rules.
Always. Instant payments, regulation implementation, reforms to the Trading Companies Register, RCS, and Beneficial Owner Register, RBE, more powers, higher late filing fees since March this year, implementation of MICA for crypto assets, the new LTIF 2.0 rules for long-term investment funds.
It's a blizzard of acronyms and regulations. Any key circulars or guidance?
The AED, the AML authority, expanded its reporting scope to cover all unregulated AIFs, including RAIFs. Deadlines are coming up fast for those reports.
So increased AML oversight.
Definitely signals stricter enforcement. The CSSF has also been active, issuing guidance aligned with European Banking Authority guidelines on MLTF risk factors, the travel rule for crypto transfers, and constantly reminding firms about DORA readiness. Tax authorities, as mentioned, issued that key circular on reverse hybrid rules.
And that court ruling on substance.
Yes, the High Administrative Court case 50602C from April really reinforces substance over form and the power of anti-abuse rules. A must-read judgment.
Anything specific to note for today, May 9th?
Well, it's Europe Day, a public holiday here. Also, worth remembering that 2.5% automatic wage indexation kicked in on May 1st, affecting payroll costs. Those increased RCS-RBE late filing fees are now active. We've seen recent official publications. EY just put out their PE Watch discussing that court ruling, and the CSSF is busy supervising DOR and MICA implementation.
Constant motion. What's the buzz from law firms and industry bodies like ALFI or LPEA?
Lots of analysis. KPMG and ALFI's recent private debt survey showed strong growth in that sector, predicting AIFMD2 will be a game changer. LPA highlights PE resilience, reporting huge NAV figures for 2023.
And the law firms.
They're all over the new legislation, DOR, MICA, Pillar 2 updates galore. Discussions continue on REAF popularity versus CEFs. Some still note the common use of PECs in PE deals and that historical 85.15 benchmark, though always with the substance caveat now. Lots of focus, too, on practical impacts, wage indexation, Pillar 2 accounting, Vita rollout, those RCS-RBE fees. The substance ruling is a hot topic everywhere.
It sounds like the message is clear. Adapt or struggle.
Pretty much. Luxembourg is adapting to international standards, but the complexity is rising fast. Specialized advice is no longer optional.
Okay, bringing this all together as we wrap up. For someone considering using hybrid instruments in Luxembourg today, what are the key strategic takeaways?
Look, the traditional theoretical benefits to deductibility, favorable cross-border treatment, they still exist on paper. But they are massively conditioned now.
By ATAD, reverse hybrid rules, substance.
Exactly. Transfer pricing, evolving case law.
Yeah.
You absolutely need a holistic view. Instrument terms, commercial rationale, issuer investor status, group structure, tax laws in all relevant countries.
Documentation.
Critical. Robust, detailed, contemporaneous documentation proving arm's length terms, genuine business purpose, and your compliance analysis for ATAD and reverse hybrid rules. The purely formalistic tax structure is dead.
So the new normal is?
Substance. Clear commercial logic, meticulous adherence to the rules, defensible arm's length pricing. You have to be ready to defend not just the legal form, but the genuine economic purpose behind it.
And looking ahead, the future landscape.
The pace of change isn't slowing down. Think DAC 8 on crypto reporting, maybe even an ATAD 3 down the line. Luxembourg will keep adapting to international pressure while trying to stay competitive.
Meaning more complexity.
Undoubtedly. Which makes quality, specialized advice even more vital. Generic solutions are just too risky now. Expect a continued flight to substance.
What will success look like?
The future feels like it's heading towards hyper-compliance. Competitive advantage will go to those who can demonstrate real substance, strong governance, rigorous compliance, and transparency. It's less about clever tax planning now, and more about building resilient, sustainable, defensible structures that align business goals with these heightened regulatory demands.
Substance, transparency, compliance, the new watchwords.
Absolutely. They're the key differentiators going forward.
That's a really powerful summary of a very complex topic. Thank you so much for guiding us through this deep dive.
My pleasure.
For everyone listening, we really hope this has brought some clarity to the intricate world of Luxembourg hybrid financing. The need for ongoing diligence is clear. Take some time to reflect on these strategic points and how they touch your own work.
And perhaps a final thought to leave you with. As this focus on substance intensifies and the international tax rules keep evolving, how will this fundamentally reshape the way cross-border financing involving Luxembourg is structured in the years to come?
A crucial question indeed. Something to ponder. Make sure you hit that subscribe button so you don't miss our next deep dive.
Definitely subscribe.
This has been the Luxembourg Fundcast for you today.